Lots to weigh up at the Open today. We're going to head over to Evan Lucas from IG in Melbourne to get his take on what we should be expecting. And Evan, as we pointed out there, a weaker US lead. Actually, the first down day for a Tuesday since about mid-January. They've been calling it a Super Tuesday winning streak. Is there any credence or any actual, theory behind this Tuesday winning streak, or is it just some fun data to play around with?
I think it's probably more a bit of fun data, unfortunately, Kate. Look, if you have a look at also what happened on Monday night, heading into the trade, a lot of people were actually banking on it making it 21. There was a huge amount of handovers in that last hour. In the last 2 or 3 minutes, it got even bigger again. So there was actually a bit of a fun data there. It obviously has snapped that 20-week winning streak for a Tuesday. And again, it comes back with, again, the hiccups that we're going to experience as more and more people start talking about the Fed. Last night, we actually saw relatively good trade deficit numbers coming out of the US. It did widen. It jumped up by about 8.5%. Was below estimates, but it did come off a 3-year low. It does suggest the US consumer is picking up. Imports of things like automobiles, computers and consumer goods like that were on the way up, and it was relatively good data, and that's what the kind of data the Fed is looking for, things that can show the US economy is standing on its own 2 feet. And that again is making that short-sightedness of the current market situation a little bit more volatile. Again, we saw another FOMC member, and she has been doing it for quite a while, in Esther George, continuing her hawkish talk about winding down the spending very much in the interim rather than sort of on a medium to longer term view. And also Goldman Sachs and Deutsche Bank both started to come out with their top economists saying that September is about that point, and all that sort of culminated in a bit of a fall. It's going to create a lot of sort of hiccups on the way along. And the issue that I have with the current situation is that if the market does start to really move away as tapering does come in, and the Fed has said it will, it could actually create a situation where the Fed has to jump back in, and that's unfortunate for where it's currently standing. We do believe the US economy is moving further forward, and we would like to see it on its own 2 feet, because that means growth is happening and it is actually sustainable rather than actually being liquidity funded.
We've also got GDP figures due out today here, Evan, which will be interesting. And recently we've seen the current account numbers reveal that exports are continuing to prop up these figures. What does it mean for this GDP read today?
Yeah, yesterday's current account figures were quite interesting. The deficit was actually lower than estimated at 8.5 billion. Having a look, the net exports on there actually could add about 1%. Most people were only expecting about 0.7, so it does put an upside to it. They did come in this morning. I did see the estimates have dropped slightly, and that's because there was a weaker than expected inventory number, so that might affect it. But the GDP print actually looks like it could be a positive read from the first 3 months of this year. It's not surprising. We did see commodity prices quite high between January and March. We also saw that the export market was also better. One thing that also distorted the current account that may be also on the cards, the import from capital, and as in money flowing into the country, was down 13% on that quarter, and most of that is probably due to the fact that the Japanese took out $16 billion in funds from Aussie bonds and also from Aussie equities in that first quarter, and that may actually see that sort of export number jumping up a little bit higher than expected. So expecting a relatively good number. It'll probably be a bit of a non-event. It may actually see the Aussie dollar having a little bit of a pop-up again today. It's sitting around that 96 cents. Most people are still expecting the Aussie dollar to actually slide, but could see a good number coming out of the GDP print today.
Okay, interesting. And for the local market, SPI futures just down a fraction at the moment. We saw industrial metals higher overnight, oil also doing well, gold not so well. How will this set up the material side of the market for the Open today?
Yeah, I think we've got to get back to looking at the iron ore price. Iron ore has finally sort of snapped out of the slump that it's been in for the last 2 weeks. It jumped up around about 2.5–3% last night to $116.9 a tonne. It's come from that 110 from about 2 days before, and that actually should put a bit more upside in, particularly in those pure plays. We did see Fortescue and Atlas Iron really sort of jumping up over the last couple of days. They've been really pushed down to the lows that we saw back in July and also in August last year, so they may be a good prop. Also having a look at BHP's ADR, it is suggesting the stock's only going to jump up about 0.1%, but if we do continue to see the rotation call that's been on with regards to moving out of the banks and those high yielding stocks, the materials play may actually have a positive. But it does look like, having a look at the SPI futures and also what the opening calls are looking at, we do look like moving lower, unfortunately, down to roughly around about 30 points on the open, and that's probably because we continue to see high yielding stocks like Telstra, Woolworths, Wesfarmers and the big four banks continuing to slide as people lock in profits and look for total returns in other areas.
Yeah, Evan, we spoke about this earlier with Mark Todd from FIG Securities, who is our guest host today, and he said he can't for the life of him understand why anyone would want to move out of the likes of the big banks and into the growth stocks like BHP Billiton or Rio or Fortescue at the moment. Perhaps you could give us an explanation.
Yeah, it's probably talking about where he's coming from is probably that retail side. The yield support in the banks is actually really starting to build up. Your ANZ, your NABs have been absolutely smashed over the last 3 weeks, and the yield support from a retail side is definitely there. But what we talk about is total returns, and the institutions have picked up those dividends and roughly about 30 to 40% growth from probably about June, July last year, and that's a total return, and they're locking that in, and they're now looking at valuations, particularly on the fundamental basis of where their next total return is coming from. Looking at that EPS growth and also earnings growth possibilities and guidance from the big miners, particularly BHP, does look quite realistic now. They've probably been on the high side, and that's what most institutions will be looking at, and that's probably why you're seeing that shift, and that's what most people are talking about. It's why your Goldman Sachs, your JP Morgans and your UBSs of this world are talking about that rotation, and why you may actually be seeing that, considering what's going on. From a yield play, yeah, you'd have to suggest that Telstra is also one that's starting to look very, very attractive. At $4.60, that's where most people were jumping in over the last couple of years, and that also has a support, but that's why we're moving out. Institutions are looking for total returns, not just yield.
Okay, interesting. Evan, thank you so much for your time this morning.
Thanks, Kate.
Evan Lucas from IG in Melbourne there. Well, time now to take a look at SPI futures, and you'll see right now they are pointing lower, down about 0.3%. Okay, time to get more on the